Navigating the economic tides, the impact of the business cycle on investment opportunities. Introduction. In the perpetual ebb and flow of the economy, the business cycle stands as a rhythmic force, shaping the trajectory of growth and contraction. Investors keen on deciphering the complex dance of markets must grapple with the nuanced interplay between the business cycle and investment opportunities. Understanding how the business cycle influences various sectors and asset classes is paramount for constructing resilient investment strategies that can weather the cyclical undulations of the economic landscape. Phases of the business cycle. The business cycle unfolds in distinct phases, each characterized by unique economic conditions that, in turn, create a shifting landscape for investors. The four primary stages include expansion, peak, contraction, and trough. During the expansion phase, economic activity flourishes, prompting increased consumer spending, corporate profits, and job creation. The peak marks the zenith of economic growth, leading to a slowdown as contraction sets in, ultimately reaching the trough before the cycle restarts. Investment opportunities during expansion. The expansion phase of the business cycle heralds a wealth of investment opportunities. As consumer confidence rises, businesses thrive, and economic indicators signal growth, investors often gravitate towards equities. Stocks of companies poised to capitalize on increasing consumer demand, such as those in the technology, consumer discretionary, and industrial sectors, may experience heightened valuations and robust returns. Real estate, too, tends to flourish during the expansion phase, with demand for commercial and residential properties surging. As businesses expand and consumers gain confidence, construction and development activities gain momentum, presenting opportunities for investors to capitalize on the upward trajectory of the real estate market. Investing during the peak. As the economy approaches its peak, prudent investors begin to reassess their portfolios. During this phase, caution may be warranted as signs of potential contraction emerge. Defensive sectors such as healthcare and utilities may become more attractive, given their historical resilience in the face of economic downturns. Additionally, investors may consider allocating a portion of their portfolio to fixed income securities, providing a hedge against potential market volatility. Opportunities in contractions and troughs. While economic contractions and troughs can evoke apprehension, astute investors recognize these phases as windows of opportunity. As stock prices decline and market sentiment turns pessimistic, valuations may become more attractive. Bargain hunters may find opportunities in sectors such as financials, which often experience a rebound as the economy starts to recover. Moreover, during economic contractions, central banks may implement monetary stimulus measures, leading to lower interest rates. This can benefit bond investors, as the prices of existing bonds rise, presenting an opportunity for capital appreciation. As the economy reaches the trough and signs of recovery emerge, investors positioned strategically may reap the rewards of their contrarian approach. Sector rotation strategies. Understanding how the business cycle affects different sectors allows investors to implement sector rotation strategies. During the early stages of an expansion, cyclical sectors like technology, industrials, and materials may outperform. As the cycle matures, defensive sectors such as utilities, healthcare, and consumer staples may take the lead. For example, consider a technology stock that thrives during the early expansion phase, driven by innovation and increased business spending. As the business cycle progresses, this stock may experience a plateau, prompting investors to reallocate towards defensive sectors that are less sensitive to economic fluctuations. Global implications and diversification. The business cycle's impact extends beyond national borders, influencing global investment opportunities. Countries and regions may experience economic cycles that are out of sync with the global cycle, providing diversification benefits for investors. Emerging markets, for instance, may offer attractive opportunities during periods of global expansion, fueled by increased demand for commodities and exports. However, global interconnectedness also means that economic downturns in one region can have ripple effects globally. Investors must consider the broader economic context and global trends when constructing diversified portfolios to mitigate risks associated with the varying phases of the business cycle. Conclusion. The business cycle, with its undulating patterns of growth and contraction, weaves a complex narrative that shapes the investment landscape. Investors who grasp the intricacies of the business cycle can navigate the ever-changing tides of the economy with finesse, identifying opportune moments to capitalize on growth and safeguarding their portfolios during periods of contraction. By aligning investment strategies with the dynamics of the business cycle, investors can enhance their ability to achieve resilient and balanced portfolios capable of weathering the cyclical nature of the financial markets.